Okay, and we are live. Welcome everyone to another episode of the Crypto Hour. Today is Friday, the 7th of June, and we have quite a lot of things to go through today. So let's start straight away with the economic calendar and with the first two bits of important news that we are seeing for quite a few months. So I'll go and cover it straight away. Let me share my screen. Can you see my screen? Yeah, perfect. Okay. As usual, let's move. The Zoom controls are always inconvenient. Okay, so this week, let me just first of all go onto this other calendar that's a lot less noisy. Go back to this week. So we had a few things, quite a slow start to the week in terms of news releases, but things that kind of to take notice and a lot of notice is first of all, as if you can see, the Canadian dollar interest rate on Wednesday actually was reduced from 5 to 4.75%. So the first of the major economies, apart from Switzerland, to lower the interest, the central bank interest rate. And also, on Wednesday we had the employment figure. This is the ADP. It's a private figure, non-farm employment change, which precedes the non-farm payrolls, which are due today by a couple of days. And sometimes it's seen as a precursor to the numbers that are going to be announced in the non-farm payroll. The narrative of job figures and job market progressively getting steadily worse is continuing. Okay, so we see the previous year was 188,000, was forecasted 173. The real figures were 152. So it's progressively the numbers are getting worse. So this is one of the things that we look at for determining interest rates. So we'll see what's happened, in the past couple of weeks as well to interest rates as they follow this kind of announcement. Like we had the the PCE inflation announcements last week, which is the main one that the Fed uses to set interest rates. And today we had we have another very important announcement, which is the non-farm payrolls, which is probably the most important of the month, determining the health in general of the American economy. Yesterday, we also had another important, which was the European interest rate, or the European Central Bank, again followed what the Canadian dollar has done already, and they lower interest rates by 0.25%. Okay, so we already heard last month a lot of noises being made by the UK Central Bank. So very probably the next move in UK interest rates is going to be down as well. So we are starting now, almost like we. Guys, I still hear some background noise. Can you make sure that your microphones are muted, please? Okay. Okay. So I was saying the interest. So it looks like we have now started the downward move in interest rates as central banks become a little bit more comfortable around inflation. Okay, so Canadian dollar, obviously, if you are also trading commodities, affects the crude oil as well. Canadian dollar and crude oil are very closely related. So if you are seeing some strange news in crude oil as well, that is why. Today, as we said, the other important announcement, very important, is the non-farm employment change. Also, you might know it as the NFP, non-farm payrolls, which gets announced once a month and is due today before the market open at, you see here in my calendar, at 1:30 p.m., which is 8:30 a.m. in New York. So 1 hour before the opening of Wall Street. And also yesterday, we've had some more figures that I will show you probably more clearly here. Thursday. So the job figures, they get announced every week. And again, slowly getting steadily worse. So the initial jobless claim actually a little bit about 8,000 higher than expected. You know, the continuing jobless claims, so people that are continuously unemployed. So the net figure again keeps ticking over towards 1.8 million. And so on. As you can see, also the productivity, non-farm productivity, grinding pretty much to a halt as expected. So what we also got to look forward to is after all these announcements for interest rates, next week we're going to have the US the US announcement, the rate, federal funds rate announcement. Again, at the moment the US has got the highest interest rates of 5.5%. You know, there's a high probability that we will see a ticking down as well of this, maybe down to 5.25% is what the markets are pretty much already discounted. And also we are going to have another CPI, which is a consumer price index figures for the US as well, just a few hours before. So Wednesday is going to be a busy day in terms of economic announcement, where you're likely to see kind of the markets just being quiet in expectation of these announcements, and then take the direction that they would, that they were going to take, but everything is going to happen fairly quickly after 7 p.m. Okay, now I wanted to go, in a way, zoom out, because we're concentrating on what's the next thing to happen. What's the price of this doing today or tomorrow or this week or next month. If we actually, I wanted to zoom out with you and just talk about kind of like some macro significant figures. So if I take it to these screenshots. So this is the way that, let's say, wealth in inverted comma is created. So how money is created in an economy. Okay, so money is created either through government deficits. So government spend money that basically they don't have, okay, or banks creating money out of, like pulling it out of the hat. Basically, whenever you go and ask for a loan or a mortgage, that's not existing money that somebody else is loaning you, is created out of nowhere. So new money gets into circulation. And everybody's richer. Okay, so we live in this like economic illusion that things grow all the time, we become better off all the time. Simply, it's an illusion because not necessarily our condition of life is getting better, but we have more money. We earn more money now than we did 20 years ago, 30 years ago, and that makes us feel richer. From the point of view of how these assets then show up on the nation's accounts, you can see from the point of view of the central bank, they got reserves, and on the liability side, they got reserves and currency. So before and after the loans, that doesn't really change very much. From the point of view of commercial banks, obviously they have this new money that's being created and filters down to the consumers. So the consumers, what do they do with their money? They now have a lot more money, let's say, in the banks. They then deposit it in a bank. So from the point of view of the bank, now they've got a bigger liability that they are going to match up with new assets, so new loans. So this is almost like a magic type. Now there is all this new money in the economy, generated completely out of nowhere. Now, from the point of view of growth, and if you look at generally for the world population or for any country's population to get better off, there are two ways of, only two ways. It's not a magic act again. There are
I
only
was
two ways
just
of
going to your
generating.
PowerPoint to just increase
Please mute your microphones, please. Okay, who's the offender? I don't know. Whenever I find you, I will mute you automatically. Okay. So there are two ways of generating structural growth. Is either with working age population growth or with productivity growth. Okay, well, we can see the relationship here between government spending and private sector spending. That is pretty much a balancing act. So if one goes up, the other one comes down. So this is the main concept of Keynesian economic is when the private sector is struggling, we inject cash in the public sector, financing jobs and public public works and so on to stimulate the private sector. So the two ways I was saying is productivity growth and working age population growth. Now, if you see the trend of working age population, this topped up in the 80s, because the biggest demographic group that we've had in the past 50, 60 years is the baby boomers, people that were born just after the end of the war, and demographically they matured and got into like working age population during the 80s. This is when there was like population growth that fueled then a general growth across all Western nations. And we can see trends here for different for France, Britain, Italy, Germany, United States, and Japan, and it's very similar all across these countries. What happened then from the 90s to the current day is that as the baby boomer generation is getting older and retiring away from the working age population, the numbers of working age population as a total population, they have gone steadily down. This is more marked as well in countries like Japan, for example, where the influx of immigrants is very little. So in many other countries that try to make up the slower population growth with an increase in immigration, like it's happening, for example, in Canada. But many other countries where this is not acceptable, like Japan, have a real problem, because now you see they're getting close to like 50% of working age population, and I'm thinking that this 50% is the one that supports the other 50% that is not working. So where in the 80s we had a relationship pretty much like around 70-30. Now in many countries we are below 60-40, and we get into the worst examples like Japan, where we are now at close to 50-50. So you can see how much pressure that puts on on the population, working population at large, and governments. So what governments do they have to balance? They have, if you think about why we got elections now in the US and in the UK, what do the politicians talk about? They have to talk about positive things. Okay, so talk about growth. We are going to be help growth by taking this initiative and that initiative, and the Conservatives will do it one way, Labour will do it in another, Independents will do it in a different way. But pretty much they are trying to inspire people. And obviously, they can only do that when people's life situation or life condition improves. Nobody will be elected on a manifesto saying things are going to get worse for you, you're going to pay more taxes. So, so the way of balancing this structural change in terms of you can see, so that was the previous screenshot was the population growth, which was negative, and this instead is the productivity growth for the UK. This is from 250 years. Okay, so from the 1750s, and so we can see where the conditions of the general population with the Industrial Revolution, and then in the 1900s, so the productivity was growing at a fast rate. So at the very least, it was a positive growth in productivity. And where then, during the last century and this century, the productivity has gone steadily down. Where the last decade we had negative productivity. So how do governments balance that? The only way that they have of balancing this is to basically leverage. Okay, so how do you do leverage? Leverage is simply by debt. Okay, so growing debt, both as public or private debt. So if you see the trend as well of from the where we got figures for everybody from the late 90s to today, you can see that every country has done it, whether it's communist country like China or the biggest market in the world, the US or Japan or the EU. They all grown substantially the amount of debt as a percentage of GDP. Okay, so in a way they can keep feeding this illusion that that there is more. Okay, you have more money, you have more things. And if you think about how does this work? You think about it with property. We all most of us have bought property in our lifetime. So you would have bought it, let's say, at price. Let's use round figures. $100,000. Okay, so when you bought that property, say your income, you could spend, let's say, $1,000, and that would allow you to buy $100,000 of property at 10% interest rate, for example, mortgage rate. If you think about the same $1,000, when the interest rates go down from 10% to 3%, the same $1,000 a month that would allow you to buy 100,000, now that allows you to buy $300,000 property. So you can see how the market is inflated. We see, the person that bought the house at $100,000 is very happy, and she's got all this paper gain to show if they want to sell the property. The new buyer, they only care about what they can afford with the with the amount of money that they put aside for the housing investment, and everybody's happy, and there is a lot more money out in the economy, and everybody's got more money to spend. So there is this illusion of everybody getting better off, conditions being better off. Okay, but what's the trouble with that? That when the structural growth is not genuine, and it is created through leverage. Leverage is expensive, because then what is happening right now, as debt is getting larger and larger, the financing of that debt, so the amount of public money that's used to pay off public debt is larger and larger. Okay, so how do politicians square this circle? Is they've only got one thing that they can do, which is the genius idea that they had, or let's lower interest rates, so the cost of money is very low, so we can afford to create more money, because it's not costing us very much to pay the interest on it. So in reality, what is creating what would be creating growth is lower real interest rates. Okay, and now real interest rates are the nominal interest rates, minus inflation. So in a way, how do you get lower interest rates? Either reducing the nominal or increasing inflation. Okay, so we have a very difficult, very difficult circle to square, because from one point of view now, we have very high costs in terms of as we're seeing mortgage and borrowing costs in general. We also have inflation that's still above, which is still above the desired target level of 2%. Just a moment, Kerry. I'll get to you in a second. So we have this this really difficult puzzle to square, and now job figures are starting trending down as well. So the central banks will be very interested in trying to control one of their two main mandates, which is make sure that the job market is happy and the economy is still growing, while at the same time trying to control inflation. So the central banks are almost like they would be forced to lower interest rates because the other two parts of the structural growth are simply not there. So long term, our economy cannot function with a high cost of capital. So what's the kind of like, what's the prospect looking forward to the future, and from the point of view of people trying to protect their wealth, so in kind of like in positioning yourself to continue, in order to continue this illusion, we're going to have to have lower real interest rates, and at some stage this process could continue gradually, which is the desired outcome that they're trying to achieve, or it could happen all at once. We could have a crash at some stage, like we had in 2008, or with a catalyst that moves prices very quickly in a short period of time, and then eventually the market resets and starts again. From the point of view of protecting yourselves, at the moment if there is a kind of like an event that will move things sharply lower, there are three things that thrive when the market is in crisis, and the things at the moment that thrive in a crashing markets, let's call it, that could be the US dollar and US dollar direct related investments, commodities, and in particular gold. They're seen as also as a it's not an investment product as such, but is a hedge against inflation. So those are the traditional assets. Plus now we also have cryptocurrency. They are becoming available to everybody, with the Bitcoin ETFs and soon with the Ethereum ETFs. They become another asset class that can also compete with gold and other commodities, because some of these are going to be seen as commodities now going forward, that are seen as another defensive product. But from the point of view of cryptocurrency, there's also the potential of great capital appreciation as there is basically asset rotation between traditional asset classes and cryptocurrencies. Now, just Kerry, do you have a question before we move on to other things? Kerry, still there? No, I think you raised the hand before.
Sorry, I did. I was trying to find my mic. Morning, everybody. How are you all doing? Apologies. Nice to see you all. Luca, I have a few questions actually, and I don't want to dominate it, so maybe just help me. I'm going to ask them all. Maybe you can answer them as one. So the first thing is, obviously with these, I'm guessing it's all got to do with the reduction of birth rates as to why we've got pressure's being created on this so-called working force, because the working force is kind of getting older, not younger by the looks of it. And that's due to birth rates, right? So I would imagine that's as economies mature. So what's the flip side? Is it a case of saying, well, we've got to have more children? Is that kind of so that's the one part. The second part of my question is, so with interest rates, obviously we understand that's all inflation linked. And then we hear that sometimes they remove money out of the system. So is that then essentially the opposite of interest rates? So, okay, well, we're not going to print more money. We're actually going to remove money. I don't really believe that they do that ever. And if they do, how do they do that? I guess the other thing that kind of I wonder about is this whole thing around fractional reserve banking, because that's also another factor. So in the past, there was always a requirement to have a certain amount of what's unencumbered funding, as I think they refer to it, in terms of the amount of loans and debt that's out there. Now I think that's fallen away totally. So that's probably even further exacerbated the issue. And then my last kind of question to the whole thing is to say, right, so now we move into cryptos to avoid this imminent, financial crisis crash or a crash of the dollar. But obviously at some point, as we start to see growth or returns, if we disinvest in crypto, do we just move to other altcoins, or where do we go? Do we go to gold? Do we go back into fiat? Do we go into property? So sorry, it's a big question, but that's where I'm at the moment. Thank you.
Okay, just very quickly, I'm not going to spend too much on this, but okay, the first question about, yes, it is birth rates that has gone down in the Western and all the Western economies. So what's the problem? Yes, ideally, there could be policies that encourage to have more children. That's not likely to happen because it's something like a modern economy results of people getting better off. And especially as both couples, man and woman now are equally working, there is less propensity to have a large family. So it's not going to be an option in all the Western countries. So it's the other policy that nobody wants to hear. And I've said it before to you all. For me, the most successful countries will be the ones that attract the best immigration to their countries. Because that is going to happen, because there are countries where the population is going up, and there are countries that don't have enough working age population to support that non-working age population. So there is only one way, is to have more workers coming into your countries. And we already see I don't know if there's anybody from Canada here, but Canada has become has really invested heavily in attracting immigration, because they realize that they've got a lot of land, they've got a lot of natural resources, but they haven't got enough people to cover all the jobs that they need to be done. And it's strange, because we have a resurgence of the right in Europe, not only in the UK, where where we had Brexit a few years ago, but in other countries, like Hungary, Poland and Czech Republic. So we are starting seeing in Italy as well. So in a lot of Western economies now, the right is becoming defensive position, is becoming more popular, and there is more talk against immigration. But the politicians themselves, they know that their country can only grow if they can attract more immigration, not less. So they will be saying one thing to keep, basically to throw meat to their electorate, but really with their policies they will be doing the opposite, because otherwise simply the countries will not survive. We've seen the effect of the Brexit policies, just for example, because the thing that's more easy to observe. We have started seeing it now in the UK, where there are crops in the fields, they are rotting because there aren't enough people to collect the crops. So this is the reality of modern economy. But the problem is that the political system is not right to take the actions that need to be taken to rectify this, because sometimes the decisions that need to be making are long-term decisions, and all the politicians look at is the next 4 or 5 years. Will I be re-elected when there is the next election? So they can't take any decisions that are unpopular and they will need to be taken, and do the right thing for their country, because simply their job would disappear if they did that. From the point of view where you were saying central banks remove and increase liquidity, or saying monetary tightening and monetary easing, yes, no, they do that all the time. They do it through the bond market. So it's not most of the time it's a slow process that they will tighten it by not renewing certain bonds that come to maturity. So not necessarily, generally speaking, a lot of bonds get rolled over. So there is a tranche of bonds that were issued maybe 20 years ago that are now coming to maturity, and then the government reissues the same amount of bonds going forward and more. But sometimes when they want to tighten, they will then take these out of the market without renewing it, because when they do the money printing, they got a big treasure chest then that they can at will they can play out in the markets when they when they want to. So we had a big increase in the amount of money in circulation during the pandemic, because this is obviously nobody was working, or at least not many people were, but but they still were being paid a full wage to be able to survive. So that increased the amount of money in circulation. That at some stage had to be reduced. That hasn't quite. So it started happening very, very slowly, and we started seeing the effect. But the effects, as we were talking about last week, are slow, because obviously individuals make individual decisions, and if you have interest rates that are close to zero, then you will secure it for as long as you can in case things change. So a lot of people secure their debts for a long time, and we're seeing like a gradual effect on the economy of the rise of interest rates, which is starting to bite. It's starting to bite now, because the, as you can see here, the mortgage rate in the US is a very, very long-term fix. So the majority of mortgages are more than 10-year expiry, with a lot of them on 20 or 30-year mortgages. So the effects of those will be gradual. So I know that every year an 8% of mortgages come to refinance, and all the ones that are being refinanced are at a higher price. So this is what we see, just recently from the end of 2022, that we're seeing that the debt service ratio starting to climb back now to the 20-year average, and these are numbers that are like 6 months old, by the way. So it could even start climbing towards the 2007 peak. And so if we go back to the average of how much money basically people are able to spend in the economy. Also, what follows as well is that the over kind of like the earning per shares that are being traded in the markets will be going back to the average, because when the money increased in 2020, you have to find a place somewhere. So a lot of it found its way into companies' profits, okay, because people had more money that they didn't need, so they invested it in stocks and shares. So, and there was generally more money in the economy for people to spend, and obviously companies that produces product that people wanted to buy will then reap the rewards. Now, as there is less money, less liquidity in the system, so people have got less money to spend. Also, this is now showing on the company's bottom line. And although we had the stock market growing at increasing pace and going to all-time highs, the one thing to watch is that who's actually driving this. We got companies like Nvidia that is now trading as much as the other top 20 companies in the S&P 500. So are those numbers that we see, the average numbers, the 500 shares, are those significant or not? When really, yes, we're talking about 500 shares, but the top 5 or 6 probably do 90% of the of the volume and of the increase or decrease. So it's a bleak outlook, a little like the one I'm talking about, but it's something that I assume that we are going slowly moving towards. If we see what happened, so with the latest expectations of the market, if we go and have a look at what I was saying to you before, is that we have seen a change. Let me go to daily charts. Sorry. So this is the interest rate in the market, so the yield. Okay, not the coupon. Okay, obviously that all the new issuance are around 5.5%. So, but this is the market price. So how much, if you go and buy bonds on the market, 20-year plus bonds, what kind of interest rates would you receive? So the difference between the price and the coupon itself, this is the yield that you will get right now, which is 4.5%. Remember, interest rate is at 5.5. And as we have, we were showing before that the job numbers have started giving us inclination that, that things are not all rosy in the economy. But we can see that the expectation of the markets has been for a cut of interest rates. So even from end of April, which when we were around 5% in market pricing for 20 plus year bonds, at today's price is 4.5%. So that means like 2 interest rate cuts, that the market has priced in since since the end of April. So we're not even going to this the October top here, but just a recent move down. And this obviously the price of bonds is inversely related to interest rate, to the yield. So as the yield goes down, the price of bonds goes up, and we can see. So this is the equivalent ETF fund, the TLT, which marks the price of a basket of bonds with expiry at 20-year plus. Okay, so 20, 25, 30-year bonds, and we can see as that price again from the end of April has moved from, you can see 87 to 93. So it's been quite a significant. So this is this is a big move in terms of bond prices. So it's almost 7%. So if you had bought some bonds at the end of April, apart from receiving a monthly coupon, you would have been your investment, your capital would have gone up by 7%. And this is being defensive, not being aggressive in terms of your investment, because this is, at the end of the day, you are buying US debt, and it's a very liquid way of having US dollars. So that's the one effect. What's the other effect that an expectation lower interest rates has? It's higher price of commodities. So what's happening with sorry, let me just do another chart, because this is a bit too so this is gold price. So the same thing that we saw in interest rates. What's happening as the interest rates, the market price is in lower interest rates, is that obviously gold price appreciates, because if people can make the higher the interest rate and the lower the appeal of gold is, because gold doesn't pay any interest. But again, it's since the end of May has grown by about 5%. Okay, and again, it will be in a certain way inversely related to the interest rates that you get on the dollar. As an effect, obviously, the dollar is also highly correlated to the interest rates. So if you see, this is the price of the dollar against a basket of currencies called the dollar index. And you see, it's not by chance. So all these things are showing you are starting around the same time, end of April. Okay, so we go here, 1st of May, when we had the first drop in the price of the dollar, which again follows the expectation of lower interest rates. Why today's announcement is important is because another deterioration of the job figures, if we see that, is another reason for the Fed to cut rates. So if that happens, if we see bad job figures, so the expectation would be then again a weakening of the dollar, a pricing in maybe of even lower interest rates in the markets, and then some pressure on the Fed next week to actually follow this move by lowering interest rates in central bank interest rates. Now let's go and see some other. Let's go move on to crypto news, and there are some more things I wanted to show you. So there's a couple of couple of charts. So these are Bitcoin annualized returns on if you consider like a 4-year investment periods. So if you see Bitcoin as a hedge against inflation, so you put it against as something like that you could use for the same reason, like gold or like the S&P 500. But we've seen over that period, gold has returned about 8.6%, the S&P 500 17%, and Bitcoin is now 76%. Even considering the the bear market and the bear cycle. So we can see what normally happens in an economy when there are two examples of we've had this in the past in many different economy, from Roman times to Chinese China, and in many other countries, when we have good money and bad money coexisting. What happens is that generally the bad money pushes the good money out of circulation, because obviously people want to spend the bad money and keep the good money for savings. So what could we see in the future as the Bitcoin becomes more of an option and other cryptocurrency become more an option for people to kind of like keep their savings? So we could see a big move from traditional savings vehicles to cryptocurrency savings vehicle. Obviously we got ETFs and especially Bitcoin. Ethereum hasn't launched yet, but it's coming. This is now the possibility of a inverse bank run, then where people not taking cash out, but basically just bypassing the banking system directly. So whenever they have money saved, they won't be keeping it in the bank. They will be transferring it into, something like, Bitcoin. They traditionally seen now more and more as a commodity and being accepted as an institutional asset now, which is important. In terms of view of what the price is doing or not doing. So we've seen that there are periods of risk on and risk off in kind of Bitcoin prices. Now, whenever all the periods following these peaks in kind of a risk off that we are seeing right now, as the market has started turning, will then be followed by the opposite period in the other direction, where it becomes now a risk on mode, especially if we see a lowering of the interest rates, and that can then push us to to the next price discovery phase in Bitcoin that we've been waiting for a little while. And that's one of the other indications as well of where crypto prices are going. So as the price of Bitcoin has got stable at kind of like in the high 60s, 60,000, we also see the level of Bitcoin on exchanges has carried on going steadily down. So we are the lowest level of Bitcoin available for circulation that there's ever been. And obviously the halving has made this even more obvious now, because there are less Bitcoins being created every day. So it's almost as all these things are pointing to kind of like a bubble that is going, just ready to burst, but not quite yet. But the pressure is definitely mounting. If we go and look at, so if I show you the Bitcoin, the Bitcoin chart.
Rather than a bubble bursting, Luca, you mean a run starting?
Sorry, yeah, bubble bursting.
Rather than a bubble bursting, you mean a run starting, like forward momentum.
Yeah, what I'm saying, a bubble bursting is a pressure bubble.
Yeah. Okay.
So that's building right now. So if we see what happened during the last week, the reality is not much. We're still in this price range that we've been since the 20th of May. So it's gone between 65 and 70,000 at the moment. The past this week we've then quickly moved as you can see now, during weekends, they used to have lots of movement on weekends. Now it's just like weekends are almost like a non-event in crypto. Prices are in a very narrow band for the whole weekend. But this is Monday, Tuesday, Wednesday, Thursday, and Friday. So we are now, for 3 days, we've been playing in between 70 and 72. And we're just waiting to basically have a momentum move above the 72,000, because above that level there is quite a lot of stops, kind of like bearish stops in a way, so protective stops in case price went above a certain level that could then trigger and become buy orders to push the price to new levels. So if we see here, we can see where the levels are at the moment. Just short of 72,000. We can see we got quite between 71.9 and 72. We're talking about more than 100 million of liquidation that would happen at that if price went about this level. So it could be a cascading effect, like often happens to Bitcoin, where not much happens for a while, and then all of a sudden all the move happens at the same time. Another thing to notice this week, and we're talking about it last week, is how much the ETFs are started pulling again. If we see what was happening a couple of weeks ago, where we had kind of like increases of 20, 30, 50 million a day. This week, look at the difference. 100 million, 800 million on Tuesday. 500 million on Wednesday, 200 on Thursday. Plus, we don't know what's going to be like today. But this is, just this week, we had over 1.5 billion being added to the ETFs. The other thing of note is that who's actually pulling in all these investment, the two major ones are, as usual, Grayscale and Fidelity, which are the ones with the biggest. Grayscale, BlackRock and Fidelity. So you can see BlackRock pulled 750 million just this week. And similarly, this very similar thing for Fidelity, say 600, about almost like 700 million in just 1 week. So the total now, we have over 15.5 billion now. So we were at 12 billion for quite a while. So money coming in, money going out was balancing itself, as we can see here, all this period from 15th of March until mid-May. And now we're starting to build again. Can you see this day here, the 4th of June, which was the second highest day in terms of inflows ever since the mid-March, when we reached the previous high. So it's significant. The other thing that's significant is now the Grayscale became the second holder of Bitcoin, and BlackRock ETF has now taken the lead. So remember, Grayscale started with 625,000 Bitcoin. So they've dropped now well over 50% of what they had in the funds. And the reason why this is significant, who cares if the Bitcoin are held by Grayscale, but BlackRock, Fidelity, they're all private companies. But it's because all the selling pressure had come from Grayscale, and as there are less and less coins in the fund itself, also the selling pressure, you can see here on the left, which they almost dropped 18 billion worth of Bitcoin. Now that selling pressure is drying up. Can you see now the red numbers here on this column in the left are getting smaller, where before we had 300 million, 400 million, 200 million a day. Now they are, even if we have red numbers like yesterday, it's like 37 million. We also had 2 positive days. So this week they actually added to the total rather than taking off. A lot less than the others, but still they haven't dropped this week. So the selling effect is becoming less important, and the buying effect is still there. Okay. So in terms of news, there's a couple of things that I wanted to bring to your attention. Kraken, sorry, I don't want things. Kraken is now doing a pre-IPO fundraising. So after Coinbase, Kraken could become the next exchange, global exchange to have an IPO. Okay, again, it's showing as the market is maturing and is coming into the forefront now with lots of product being regulated and also being present on the stock exchanges for everybody to invest in, because there's more demand, the volume is growing, so there are more companies that can make more money, like Coinbase and Kraken and all the other exchanges. Let me see, we haven't got that. This is what I wanted to relate. I mean, there's something economically is known as the Gresham's law, which is basically kind of like bad money driving good money out of circulation. So this is something that we've seen throughout history, from the Roman time, where some of the Roman emperor had started filing the gold coins, so people didn't want to use them as much and wanted other coins that were more reliable, to the current day. Because what happened since 1971 is that obviously, there is a completely floating monetary system compared to something that's based on something physical like gold, and it is a inevitable phenomenon of human nature that people would, whenever there's a better alternative, the better alternative will then be favored against the weaker alternative. So the more and more we're seeing, the reason why we're seeing gold at such high prices and Bitcoin hitting new all-time highs, and the same for silver and other commodities, is because it's seen as good saving vehicle compared to bad saving vehicle. So the Gresham law basically is predictive a massive digital bank run, because the only way it could manifest in a digital economy is for people to send fiat out of their bank to buy Bitcoin. Okay, so eventually, as we are moving from a current market in crypto of about 5%, as it grows, the net loser out of this process are the traditional financial providers, because it's the way their model works. So they need deposits so that they can then loan money. And going back to what Kerry was saying before, we said the fractional reserve system is something that it's in place, but what the controls of that are up to the regulator. So the regulator can then determine how much or how little the banks need to be keeping in their reserves to be allowed to lend. So that multiplier, so for every dollar that is in a deposit, they can lend 9 times, 10 times, 8 times, 5 times. So that control is in the hands of the regulator. So they can play with that if they want the private sector to generate more, more new money. They will reduce those requirements. So let's say a bank, instead of being able to lend 8 times their deposits, they might be allowed to lend, 15 times the deposits or something like this. So if they want to restrict it, to make sure, especially like what happened after 2008, the opposite happened, where the banks had to keep higher reserves to be able to lend. So the fractional reserve system is there. It's just that the way that politicians sometimes central banks will control those levers to obtain their means, what they're trying to do. But that's long term, what is going to happen, in the current circumstances. So from what we see from the assets that are available in the market, if it carries on along these conditions, we'll see a move towards moving away from traditional assets to digital assets. And so this is the way the coins, they are in the digital world more easy to find, and with better features will win out in the long term. What did I have? Oh, that's the other big news of the week is this. Now, Bybit suddenly opened up registration and authentication for users in China. Okay, so again, the Chinese economy is a sleeping giant at the moment in crypto. So, again, expect, if this is carrying on, expect a lot more volume to come from China that could add to the current activity. So Chinese already could own cryptocurrency, just they couldn't trade them. So these exchanges are pretty much been outlawed in China. So if this is starting to happen again, then it could be another thing that's pointing to the increased volumes in crypto that we're seeing right now. And also before we go, there's another thing that it's so the reality of what's happening in the real world, as opposed to sensational announcements, is that there was a deal being struck between Cardano and one of Argentina's provinces, Entre Rios. It's the central province near Buenos Aires. To increase blockchain adoption in Argentina. And you know how Argentina now are looking at different options to move away from having to rely on the US dollar for their currency. So they have discussion as well with El Salvador, with their example to how they managed their transition. So this is, these are the kind of things that you don't really read in the news, because the news are dominated by Ethereum news providers, and Cardano, it's a community that does a lot of its work in the background, but it's not really shouted out. So if there is one criticism, is that we don't hear enough of it. We're there for what is going on, what the work that they've done in Argentina, the work they've done in Ethiopia, in Georgia, in other countries. So it takes time to actually carve out agreement with politicians and at the countries and regions for this project. But this is the work that Cardano is doing behind the lines. So don't just look at things like this, or with everything that happens, they always look at is that going to manifest in price? Price is not directly correlated to the activity that goes on. It's more like being manipulated in other ways. But that is one bit of news that maybe, I don't know if Jonathan would talk about a little bit more of that in his session later. But it's definitely one of the things that are starting to be seen in the real world as we move into the reality of using the blockchain and not just talking about it. Kerry, you have another question?
I do, yeah. Can you please comment on either where to find it, or what the view is in terms of the significance of whales in the Bitcoin market at the moment? So obviously we talk about the availability of Bitcoin reducing. Is that still largely influenced? Is the price still largely influenced by bulls, or by whales, or is that essentially less of a factor these days?
No, obviously, big holders of anything can influence price. But what we were looking at, at the end of the day, price is determined. So the price is what the last transaction that has been made. Okay, so it's, as you can see, there's only a small fraction of Bitcoin that can actually be transacted. They are in circulation, because a lot of them, the ones that are in cold storage, obviously they're not being traded. So we only look at, if we look at demand and supply, then we have to analyze, okay, what's the level of demand and what's the level of supply? And as the supply gets smaller, if the other things don't change, so if the demand stayed the same and the supply gets smaller, then that's an upward push on prices. The same thing if the supply stayed the same but the demand grows, we have the same pressure up in prices. So big holders, and this is why sometimes we talk about whales, because if you look at the behavior of big holders, they behave slightly differently from the rest of the groups. And in Bitcoin, we can see exactly how big a wallet is that is making a transaction. So we can get an idea of if the activity is general activity is of one of accumulation or is one of distribution. Okay, so when the whales, for example, are selling because their price has reached a level where they're happy, then they think it's whatever they're holding is expensive, and they sell out and then they buy back at a lower price. So it's not just in Bitcoin, but also the other thing to notice was Cardano. Recently, we've had a large increase in whales transactions in Cardano, again indicating an accumulation that generally predates any price action. And the same thing we are seeing in Bitcoin. Okay, so there's a lot more websites that look into Bitcoin and there are looking into Cardano. So this is why it's being reported a lot more. But those figures are available. You can have a look onto Glassnodes. You can look into Sentiment. So there are many different places where you can get this this information. A lot of places you have to pay for it, but it is available to everybody.
Thank you so much.
You're welcome. So let me stop sharing if I can find the button. Okay, I think. Okay. Just a second. Anybody has any question to ask? You're all happy?
Luke, I've got one question. Have you got that variable rate graph that you can click onto very quickly again?
Yeah, just a second. This one.
Yeah, look, I'm every time I see this, I'm just staggered. So here in Australia, we're sitting at 74%, right?
Yeah.
And if you went back sort of 5 years ago, you would have seen that would have been a lot lower. When interest rates were a lot lower. So that's 74%. That's just extra sandbags that we've got on our backpack that make life a lot harder.
Yeah.
In the US, if they went from 4% to 6% or 7% or 10%, that would be massive ramifications.
Yeah, definitely. You're right.
And what that means for us here in Australia is the US sneezes, we catch a cold.
That's a very good, Stan. Yeah, I mean, it's the only difference is that, if especially the countries at the top, Finland, Australia, Ireland, Sweden, then that means that the effects of a change in interest rate are felt straight away. Okay, and so by now you have digested these change in interest rates. So in the US, they haven't even started, so they're just about starting now, because it's only when you renegotiating these loans that you feel the pain in your pocket. So basically at the top, that pain has been digested already. And also what you will see is the other thing is true as well. So as these interest rates will start coming down, then obviously these are the countries that benefit from it the most. Okay, because most of them are in variable rates, so they will feel the effect of lowering things in the sense they will have more money in their pocket. So the opposite is true as well. It's not all, it's negative, obviously, when interest rates are going up, but it's also positive when interest rates are coming down. What is difficult for these guys that, however, even if the interest rates go down, whatever they renew at will be higher than what they paid when interest rates were pretty much 0%.
Yeah.
Okay.
What
So, yeah.
and look at the different thing about being in the U.S., which is I know is just being now in New Zealand as well, is that when they get a 25 or 30-year loan, that's the period that it's tacked to. Where in New Zealand, the maximum that you can fix it for is 5 years. So you're constantly in a turnover position. So and the only people that seem to be getting, I think, screwed are some people have decided that they're still only have, I think, a 3 or 4 year window. If somebody only wants to pay interest only here in the States. But as soon as things drop again, then people will fix them, to a thing. So it's a whole gamut of things. It's just very different, in the US. And I don't know, in Australia, Stan, how long can you actually fix a loan for? Is it kind of like max 5 years?
5 years.
Yeah. Okay.
Yep.
Yeah. Okay.
And all of those 5 years have really come to an end now.
Yeah.
That's why we've got up so high.
Yeah. Yeah. Okay.
Okay.
Question.
All right, guys. So, sorry, Chad, do you have something to say?
More of a question, if you wouldn't mind. I would imagine the states wanted to start lifting interest rates because I guess it attracts cash. By the same token, do you think the US have held off waiting for Canada, Europe, and maybe the UK to drop interest rates first? Does this help them with money flow and keeping USD maybe?
No, it's not. I don't think so. I think they're just they're just serving their own interest. So it's just they are following. So they're not reacting to anybody else, to be honest with you. They're just doing it just when they're ready and when the political condition allows them to start doing that. So they're saying that they're not connected politically, but I don't believe that 100%, So
for sure.
Obviously, as there would be a lot of interest in making people feel better just before the elections, I feel. So this is why I think the cut in interest rates will start coming now, because as we go closer to November and to the election date, then you want to have a couple of cuts to make people feel a bit happier, So that's how I see it. And maybe I'm cynical, but being Italian, I've seen too many of these things already, these games.
No, the summer is the time where the parties start having their big thing. They've had their primaries and all that stuff. So it's the political campaign will be definitely in the next 2 to 3 months will be ramping up big time. So they will have to start doing something because they've got to get people on their sides to vote for them. Yeah,
exactly. So yeah, that's how I see it as well. And we'll see what the next few months will bring. But obviously, I don't think that we're going to see a sharp move in the stocks and share index, at least not for the time being, because again, the effect of lower interest rates could be actually put more fuel on the fire. So a short term probably will see an increase in prices again, and then the adjustment will come, I think, later once we've gone past the elections probably. Ross, did you have a question there? I can see the hand raised.
Luca, just something slightly different. If you look at a Bitcoin ETF, like BlackRock, for example, do they have to hold Bitcoin in reserve? How does that work? Do they actually buy a whole lot of Bitcoin and then effectively, or do they just track the price? In other words, I'm trying to find out, how does it affect as people put more and more funds into the ETFs?
An ETF is a passive vehicle. It's a passive vehicle. So any dollar that goes into an ETF, they have to go out and buy Bitcoins in the spot market, wherever they are. Normally, these companies, most of they all use Coinbase for the custody. So they will have to go on the market on Coinbase, buy spot Bitcoin, and then Coinbase will custody for them. But they can't just decide to do what they want with the funds. They have to buy Bitcoin.
Okay, I got it. Yeah. So that, in other words, it's backed up by the coins themselves.
Yeah, exactly. So this is why it was so long to be approved, because it's a spot. So the futures is just like a price bet. This spot is a reality. They have to go out and buy Bitcoin. So obviously the regulator knew that when that got approved, it will make price jump up. because they have to remove Bitcoin from circulation when they are investing funds. The same thing is not true for the futures, because if you buy futures, it just gets settled in cash at the expiry date of the future, so it doesn't have the same effect on the price of Bitcoin.
Thank you.
Okay, guys, I will need to end the call here. I'll just remind you that Jonathan runs a session on Cardano that will start pretty much now. The link is in the chat box. So there is a lot of things going on in Cardano. Also, a lot of Charles Hoskinson has been very vocal. So if you want to understand something more about real work that's going on in cryptocurrency, I will suggest that you follow Charles Hoskinson, because it's very active on YouTube, on X. He does live sessions all the time. So it's been the first stop for many people wanting to understand more about cryptocurrency, and both Jonathan and I will love Cardano, as you know. So if you want to know about how the good guys are working, then go and spend some time with Jonathan. Okay, but remember, it's your double bill. You come to this between 8 and 9, then you make a cup of tea, and then you go and sit out with Jonathan for a while. All right, guys.
Thank you so much.
No problem. I wish you a fantastic weekend. Be safe. Be careful if you are in the markets. Be careful today, in a few hours, with the NFP release. And good luck, everyone. So have a great weekend.
Thanks,
and Chuck,
Luca.
I will send you a link in a second.